About 6 months ago in this venue, I talked about the dangers of high frequency trading and the possibility of a liquidity vacuum happening in our trading markets, the kind of event that so far we had only witnessed in 1987. And something very similar is exactly what happened last week when our markets dropped in a matter of seconds by a measure of almost 10% and then subsequently rebounded again very fast by almost that much. That clearly indicated that there was, and there is still, in fact, a structural deficiency with our markets, and that was exactly the problem that I was trying to warn and point out about 6 months ago. The fact that the problem is a structural issue is very serious, because it means that until we actually fix this problem, liquidity vacuums like it happened last week, it could happen again. The media attention right now is focusing on a couple of theories, and while that type of investigation is in fact important because we do want to know exactly what happened, in terms of fixing the issue, it really is irrelevant. We're sort of focusing on a couple of ideas. The fact that maybe the problem was a fat finger type of situation when a trader really entered a much larger sell order than what intended, maybe something in the order of billions of dollars instead of millions of dollars, or perhaps an algorithm, a type of program trading went completely crazy, inundating the market with many and very fast sell orders. Now, that may very well be the case, but the fact of the matter is that a functioning financial system should not be at the mercy of a fat finger type of issue. The issue is much more serious. Again, it is structural, and it goes back to what I was warning 6 months ago, the fact that Wall Street has been basically taken over by the machines. Too much volume today happens through machines, through program trading, high frequency trading, the type of trading that really is just based on price relationships and executed at insane speed. That basically does not allow for the real money buyer and sellers to properly adjust their positions, to properly act in the market, and to properly react to the events that constantly hit our daily trading. That is a real issue these days. And of course, what it also does is it creates a false idea of what the real liquidity in the market is, because we see a lot of volume, but that is really just toxic volume, because when you need it the most, as we have seen last week, it just disappeared very quickly. The machines will have the unfortunate byproduct of exacerbating moves to the upside and to the downside, even though of course it tends to be a lot more devastating and more media grabbing when it happens to the downside. So the move gets exacerbated, and then the machines, when the market becomes unstable, they will turn off, basically draining that liquidity practically immediately. That is a very unhealthy way of running a market, and that's a structural issue that needs to be addressed. The other issue has to do with the fragmentation of our exchanges. It used to be that about 80% of the volume was exchanged on the New York Stock Exchange. Now we have at least 4 or 5 major exchanges, a lot of electronic trading going on there, which is fine, because certainly providing more liquidity, providing competition to the one major exchange has something good about it. But the problem is also the regulatory framework has not followed that fragmentation. It did not follow a coherent course of action. So now you actually end up having some exchanges like the New York Stock Exchange that will try to slow down trading during these orderly markets, and other exchanges that will not. That creates imbalances and again exacerbates the moves and exacerbates the instability of the markets. We really need to take a hard look at the way we run our markets. We need to make structural changes, otherwise what happened last week, it will happen again and again. It will happen more and more frequently. This is it for now. If you want more information, please log on to gbr.pepperdine.edu.